Ladies and gentlemen, good day and welcome to the Bajaj Finserv Limited Q1 FY27 earnings conference call, hosted by JM Financial Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Raghavesh from JM Financial Limited. Thank you, and over to you, sir.
Thank you, Manav. Good evening, everyone, and welcome to the Q1 FY27 earnings conference call for Bajaj Finserv Limited. First, I would like to thank the management of Bajaj Finserv for giving us the opportunity to host this call. As always, we'll have opening comments from the management team, post which we'll open the floor for Q&A. From the management side today, we have Mr. S. Srinivasan, President, Insurance and Special Projects, Bajaj Finserv Limited; Mr. Ramandeep Singh Sahni, CFO, Bajaj Finserv Limited; Mr. Tapan Singhal, MD and CEO, Bajaj General Insurance Limited; Mr. Tarun Chugh, MD and CEO, Bajaj Life Insurance Limited; Mr. Avais Karmali, CFO, Bajaj General Insurance; Mr. Vipin Bansal, CFO, Bajaj Life Insurance; Mr. Ganesh Mohan, MD, Bajaj Asset Management Limited; Mr. Ashish Panchal, MD and CEO, Bajaj Finserv Direct Limited; and Mr. Deepak Matai, CEO, Bajaj Finserv Health Limited. With this, I would hand over the floor to Ramandeep sir for his opening comments. Thanks, and over to you, sir.
Thank you for the introduction. Good evening, everybody. We welcome you to the conference call to discuss the results of Bajaj Finserv Limited, BFS, for Q1 FY27. As before, in this call, we will largely be concentrating on the consolidated results of BFS, the results of our insurance operations through Bajaj General and Bajaj Life, our emerging companies which include Bajaj Finserv Health, Bajaj Finserv Direct, and Bajaj Asset Management Company, and lastly, where material, the standalone results of Bajaj Finserv. Bajaj Finance and Bajaj Housing Finance, our other material subsidiaries, have already had their conference calls, and hence we would pursue only very high-level questions on these companies. On a few hygiene points, as a word of caution, we affirm that any statements that may look forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance result. Also, to just give you on the update on the basis of accounting, as we do always, as required by the regulation, Bajaj Finserv prepares its financials in compliance with Ind AS. The insurance companies, however, are currently not covered under Ind AS, and hence they prepare their Ind AS financials only for the purpose of consolidation. Accordingly, for Bajaj General and Bajaj Life, the standalone numbers reported are on non-Ind AS accounting standard basis, which is referred as Indian GAAP, as is applicable to the insurance companies. Further on this subject, in line with the recent prescription from IRDA, both our insurance companies would transition to Ind AS from 1st of April 2027. Let me now give you a high-level update on the consolidated financial results for the quarter. The consolidated total income for Bajaj Finserv grew at 19% to 42,037 crores. And the consolidated profit after tax grew at 18% to 6,297 crores. This is just to give you a flavor of the consolidated numbers. Now I will deep dive into each company's performance, starting with Bajaj General. The GWP for Bajaj General grew at 11.3% for the quarter at 5,789 crores, which is in line with the industry GDPI growth of 11.1%. Excluding the bulky tender-driven crop and government health businesses, the GWP increased by about 10% as against the GDP growth of the industry of about 12%, a little lower than the industry due to tactical reduction in the motor segment on account of elevated pricing pressures. The underwriting loss for the company was at about 130 crores for the quarter as against 116 crores for the same period last year, impacted by high health loss ratios attributable to higher mix of the government health business in the net earned premium. The combined ratio for the quarter was elevated at about 104.7%. However, if you look at the number on old accounting basis, it's at about 103.9%. The same period last year, the combined ratio on new basis was 103.6%. The elevation is largely on account of degrowth in the fire segment as in seen for the entire industry. And also, as indicated earlier, a slight increased loss ratios on the government health business. Despite that, we believe that the reported core would be the best in the industry, despite the stress in the market in terms of pricing. The profit for the quarter was at 478 crores as against 660 crores for the same period last year. The reduction is mainly on account of lower capital gains booked in the quarter as compared to the same quarter last year due to the challenging external macro environment. The annualized ROE, excluding the surplus capital, considering solvency at 200%, stands at a healthy 17.3%. The AUM for the company for the quarter ended stood at about 35,000 crores, tad lower than the same period last year, largely attributable to the reduction in AUM from the buyback which we did in the previous quarter and a high dividend payout which we did during the quarter. Both of these combined have reduced the capital by about 3,515 crores for the company. This would mean that going forward, the ROE, which seemed to be depressed, and we were disclosing ROEs with adjusted solvency, would get normalized going forward. In summary, these operating results, including combined ratio and ROE, underscore Bajaj General's disciplined focus on delivering balanced and profitable growth in the most challenging, difficult, and highly competitive market. I will now move to Bajaj Life. Bajaj Life's financial outcomes have been in line with the plan for sustainable and profitable growth, which we had articulated in BALIC 2.0. The retail weighted receipt premium for the quarter grew at 17.5% to about 1,474 crores, better than the industry growth of 16.2%. Retail protection contributed 12% to the overall retail business, growing at 60% year-on-year. Group protection business has also registered a very healthy growth of 95% for the quarter. And accordingly, the VNB for the quarter grew at a very healthy 87% to 271 crores for the quarter. The new business margin was up at 15.9% for the quarter as against 11.1% for the same quarter last year, an expansion of 4.8%. The outcomes are despite the GST impact of 2.9% on the margins. On the back of continued strong renewal premium growth of about 18%, Bajaj Life's GWP grew 35% during the quarter. However, there were some persistency dips observed across certain cohorts, which is in line with the market, and the company is working towards improving these. The profit after tax, as was the case with Bajaj General, also degrew for Bajaj Life to about 51 crores, down from 171 crores for the same period last year, again attributable to lower capital gains during the period, which again was attributable to the external macro environment and also the GST impact which we have recently experienced. Bajaj Life ended the quarter with an AUM of 1,43,744 crores, up almost 10%. Overall, the quarter for Bajaj Life has been very good and in line with our expectations. We continue to reap the benefits of strategy of Bajaj Life 2.0 of sustainable and profitable growth. Both the insurance companies continue to be financially very strong with the solvency of Bajaj Life at 285% and Bajaj General at 254%. And hence we are very well poised to weather any external adversity. I will now move to the lending companies, starting with Bajaj Finance, a very strong quarter as you would have seen in the results declared by these companies. The number of new loans booked grew 20% to 1.61 crores in the quarter. The company's diversified business model has enabled it to record a strong AUM growth of about 24% at 5,46,944 crores. The net total income grew about 22% to 15,224 crores. PAT grew by about 27.6% to 6,081 crores. The OPEX to net total income was at 33.4% as against 33.1% for the same period last year, with the sequential increase attributable to the gold loan branch expansion. However, with visibility of green shoots in operating efficiencies due to our AI implementation, the company is confident that the OPEX to NTI ratio will improve by about 25 to 40 bips in the current financial year. The loan loss provisions was at about 1,993 crores for the quarter as against 1,969 crores for the same period last year. There was, however, a loan loss to AUF ratio reduction to about 1.54% this quarter as against 1.87% for the same period last year. Accordingly, the GNPA and NNPA are far better than what we had seen for the same period last year at 0.96% and 0.39% respectively. The capital adequacy remains strong at about 20.9% as of 30th June 26. Moving to Bajaj Housing Finance, our mortgage subsidiary, again overall good quarter for the company with a AUM growth of 24% driven by good momentum in disbursement amidst higher portfolio attrition. Growth was very well distributed across all business segments. Home loans AUM grew 20%, loan against property grew 22%, lease rental discounting 41%, and developer finance by 19%. The net interest income grew by 9% to about 968 crores. The growth was muted largely on account of attrition of higher rate portfolios. The operating efficiencies continued with OPEX to net total income at a healthy 19.6% as against 21.2% for the same period last year. Here too, a very healthy asset quality has been maintained with the GNPA and NNPA of 0.29 and 0.12 respectively for the current quarter, which is again much lower than the same numbers for the same period last year. Accordingly, the PAT grew by 23% to 715 crores on account of higher variable fee income and assignment income, reduction in OPEX and lower credit cost during the quarter. The capital adequacy ratio stood at 21.59% as of 30th June. In summary, another very strong quarter for both our lending companies, Bajaj Finance and Bajaj Housing Finance Limited. Now to give you an update on the emerging companies, I'll start with Bajaj Finserv Health. Bajaj Finserv Health executed about 6 million healthcare transactions during the quarter, up from about 5.6 million for the same period last year. The revenue for the quarter, however, registered a small degrowth on account of restructuring required in some of our partnerships on account of the recent RBI regulations around business conduct for NBFCs. Bajaj Finserv Health continued its expansion of provider network, which includes 130,000 plus doctors, 15,000 plus hospitals, and about 7,000 plus lab touchpoints. Utilizing this network strength and its tech platform, Bajaj Health is able to offer integrated OPD, IPD, and wellness experience to both retail and corporate customers. I'll now move to Bajaj Markets. The total disbursements for the quarter for Bajaj Markets was at about 2,269 crores, up from 2,046 crores for the immediately preceding quarter, and compared to the last year same quarter of about 1,209 crores. The company ended the quarter with a total unique partner count of 103. The operating revenue for the company accordingly increased to 107 crores with a healthy growth of 32%. As you may recall, the growth used to be muted for the full year last year. However, we are back on the growth trajectory after the planned digital customer journey enhancements, which had impacted the growth for FY26. Further, some of the revenue structures are now trail revenue based, providing stability, predictability, and non-linearity to the future revenues. I'll now move to the asset management company. Bajaj Asset Management Company continues its good run recording assets under management of about 31,400 crores as on 30th June 26, with a growth of 26% as compared to the same period last year. It retained the 26th spot amongst all the mutual fund companies in India in terms of AUM. Within the AUM, the equity mix stands at a healthy 63%, and the non-group share of the AUM constitutes almost 91% of the total AUM. Additionally, the company's SIP book saw a surge of 66%, with SIP folios also increasing 69% year-on-year. On the other emerging businesses, with respect to the alternate investments company, which has been set up during the last year, we have now commenced business operations with the launch of our PMS products and also expect the launch of our real estate and the AIF in the coming quarter. Also happy to confirm that the board of Bajaj Finserv has earlier during the day approved for setting up a reinsurance company as a natural progression of furthering our insurance capabilities. We shall now prepare to seek necessary regulatory approvals to set up the company. That's from my side on the performance updates. However, before we open for questions, considering the paucity of time, I would request the audience to kindly keep the questions brief so that we can cover more questions during the call. With this, I invite questions from the audience.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Before we take any questions, reminder to all participants, if you wish to ask any questions, you may press star and one. The first question is from the line of Shreya Shivani from Nomura. Please go ahead.
Yeah, thank you for the opportunity. I have two questions. First is on the general insurance business. There was a Supreme Court ruling on motor insurance third-party calculation for homemakers. If you can help us understand this, the impact on us, how are we going to reserve for it, and what is our, if any measures are being taken as an industry. My second question is on Bajaj Direct platform. So a lot of the NBFCs which have reported their first quarter results this time around have shown big uptick in digital or fintech aggregated loans, etc. And just a couple of quarters back, I think there was a lot more conversation around concerns on asset quality of this book. How has the trends been on our platform? Any color that you can give around it? Those are my two questions. Thank you.
Tapan, you want to take the first one?
Yeah. Okay. Now, when you look at the Supreme Court judgment on TV that you're saying, but after that there were two other judgments. I hope you followed that. The Punjab and the Haryana High Court, no? Now, they did not fully say that it's 30,000, and they actually one said completely very lower down version of it. So fundamentally, one has to first watch the developments. I don't think that the initial reaction of 30,000 being for everyone is being really applicable as of now what I see. Second, if you see as a company, for us, our ultimate loss ratio that we take for TP in the initial is actually a bit conservative, which actually leads to release on TP as the TP book develops. We actually mean that we already have enough buffer to absorb any such if an increase does happen subsequently. So that's already built in the reserving that we do. That is how it is done. So if as a company don't have enough reserves and that gets stressed, then I think people have to harden it. But for a company like us, where the ultimate losses that we take is it takes into consideration such kind of extrapolation. So it's already built into it. If you look at it, because we release as the book develops. So there are two things to see. So I don't think that we should get very nervous about the Supreme Court ruling as well. Third, if you look at the books of accounts, the number of cases is very few. It is not that it is a majority of such cases of housewives into the portfolio which should be there. I hope it answers the question.
Right. And in terms of any measures that the industry or all of you as an industry is taking.
See, the two things. As an industry, what we've been asking for is the TP price hike, which has been there. And that we have been talking to the regulator, to the Ministry of Finance, to MORTH, because right now the TP price happens with the MORTH in consultation with the regulator, and that is there. So we've been asking for that, and a lot of good discussions keep on happening.
All right, that's good to hear.
Also, Shreya, I understand that GIC has also filed a review petition against this judgment. So we'll have to wait and watch how this shapes out.
All right, yeah.
Ashish, over to you for the next one.
Yes. So thank you for the question on Bajaj Markets. Yes, you're right that credit quality at industry level was a bit of a concern, and it was not only for the last few quarters. It was sustained for 2-3 years. And over a period of time, we have seen our partners moving the needle towards a better position of risk matrix. The whole industry has moved for better. Starting with Bajaj Finance, many of the lenders have taken appropriate measures. We also see that. And while we have 50 plus lenders on Bajaj Markets, and each with different risk return equation, and hence their thresholds are different, they are growing their business in general, and they are growing their business with Bajaj Markets. So, yes, we see that the position has improved. And wherever we have trail revenue deals with our partners and select deals, there we have far more direct insight into the way the portfolio is behaving, and we are happy with the results. Does that answer your question?
Yeah. And just a follow-up, for majority of your lenders that you're speaking about, most of these are just going to be personal loans, right? The customer is taking a personal loan from your platform right now in this one quarter.
The platform per se has 35 different products across various asset classes. Within loans, if you ask me, we offer home loans, gold loans, personal loans, business loans, etc. But yes, as a product class, it is most amenable to digital lending. So it is a leader as a product, but we see other products also growing very fast. For example, gold loans, home loans are growing fast.
Got it. This is useful. Thank you so much, and
Thank you.
I'll get back in the queue.
Thank you. We have our next question from the line of Mayur Parkeria from Wealth Managers India. Please go ahead.
Good evening to the entire team and gentlemen, and thank you for taking my questions, and congratulations on a good set of numbers. After multiple periods of time, finally the BALIC has started showing the kind of actual numbers, which we were expecting, including FY26 and now continuing in the current year. And we hope that this continues. So all the efforts have started to show results. So congratulations on that. I had two questions basically. One is actually on general on Bajaj, and maybe Tapanji can add on that. As we see the current year panning out, there are a lot of natural disasters and situations led by multiple situations coming out. And this is spread across the country, Maharashtra, Gujarat, even South, now Assam. Many places this is happening. So it may be slightly early, I understand, but we are still, from the monsoon angle also, we are now, almost a month, 1.5 months inside this, and the disruptions taking place. What is the kind of estimate of, impact which Bajaj can see in the current, in the next couple of months or in this year, given these issues which are coming, especially with reference to motor, commercial and crop, which may have been more prone to impacts which may come because of these, floods or other natural disasters which are playing out. So that was my first question. And my second question was on the other growth, other businesses outside of insurance and lending. There is very little movement as far as the road to profitability and break-even is concerned on most of the subsidiaries bearing financial securities. So, what is our path on that? We were expecting, while break-even may be some time away, but even the improvements appear to be very shallow, and the visibility of that. So, if you can lay some path as to how do we see this over the next 18 months or till FY28, and individually, and how do we see that? Thank you. These were the two questions.
Tapan, you want to take the first one? Tapan or Aves, can you all take the first one?
No, it's a very good question. No, I think if I look at what you have asked, but if you look at globally also insurance business, it goes through cycles. There are times when the rates are hard, there are times when the rates are soft. So if you look at the Indian market, because there were no major catastrophe losses earlier, the market is soft right now, which means the pricing is much lower than what the average pricing would be in all lines of businesses, be it crop, be it fire, be it motor, be it health. So everywhere you see a soft market in the, and that's why we look at the first quarter results of quite a few of companies. Their deterioration combined ratio has been upward or close to 5% more or upward of that. But if you look at Bajaj General, it is not much. It is just about a percentage or so. What it shows is that the company has always been picking up the right kind of business and has been able to shift the lines of business depending on how the market is behaved. And nothing new. They have been doing it for 25 years now. If you look at the performance, I think at all points of time, our combined ratio compared to the market is always better than at least 16 to 18% than the market, which would be there. And it's continuing even now. So the beauty is, can you select businesses where the losses are better compared to other places, and can you get it right? I think that is what the technical expertise, underwriting skills is what it's called. If you look at crop also, you look at the segment that you picked up, and you try and see that the impact would be lower compared to other states. If you look at motor also, this time you see our motor business has gone down compared to what it was. So we have reduced our exposure there because we felt that it's not there. So this is what the company keeps on doing. But what your observation is right. Right now the market is soft. And because of if these losses happen the way it is happening, the market will harden as it progresses. But that is the nature of this business. It goes like that. So your observation is right. But Bajaj General, I think even in soft markets, always outperform the market. In fact, we are outperforming the market much more compared to what would happen in a hard market. So from that perspective, as of now, is showing good results.
So are we trying to understand that the losses can be actually quite meaningful for the industry as a whole, while Bajaj outperform is one thing, but the impact can
because if the rates soften, then the losses do move up. I think it's a very natural. That's why I said it's a cycle. Right now rates are soft. So I think the observation that you have is right.
I think, Mayur, the bigger question is for how long can people sustain this? So that is something which we have to really watch for, because while we have a very diversified portfolio, we may still outperform the market, but there will be others who may feel a huge amount of stress because of that, and hence we may see an improvement over a period of time. But as we stand today, it is looking stressed to the point you made.
And that will be further accelerated or accentuated because of the underwriting results will further get impacted because of the catastrophes of this current period which we are seeing, right?
See, that's what I said. The rates keep on changing. As of today, what you say is right. But let's say the market hardens tomorrow, then again it changes. So that is the nature of this business. That's why I said globally you'll see cycles of softness and hardness in the market. Right now the Indian market is soft. So as of today, your observation is right. Tomorrow it can change.
That will be true for the new business, for the business which has already been written.
So here, unlike life, no, you don't have a fixed contract. Every business is like a new business, even renewals also, no? You get it? It's an yearly contract, no? It's not a long-term contract.
No, I mean, even for the 1 year which has been written already, we will see the impact of that. That will be there.
Yeah, agreed. But let's say tomorrow the price is hardened by 20%. So then from tomorrow, what business you write, that moves up, no? So your earned premiums are moving up, no, after the month.
Okay.
You get it, no? So that is how, as of today, what you say is right. We have to see how the market, no, moves.
And just to add, as a company, we have a philosophy of always putting certain amount of money away for as part of NatCat reserves. We will continue to do so in the future.
See, there I think what Abhay is trying to say is that our treaties are very robust to take care of any impact from NatCats. And you would have seen that in the past few years, wherever there have been large calamities also, the net impact to us has been not very material. So I think that's the other point.
Okay. Thank you. And the second question, if you can...
Second, I'll just start by giving a summary from a Finserv perspective, and then I'll request the CEOs to also chip in. See, firstly, I think from a road to profitability perspective, we are very clear and articulate in our stance, and we've been calling it out very clearly in our investor day. And if you refer to the decks for the respective companies, you will see that we've called out the break-even. And I'll just take one company at a time. So from a Bajaj Finserv direct perspective, I think we've been very clear that we will break even in quarter 3 or quarter 4 of this year. And in fact, we had called it out that we may do it last year, but there were several changes we had to do because of the few reasons I'll talk about. One, I think we transformed the entire CRM from a frontline management perspective. Second, we had to align with the digital lending guidelines of the regulator. And thirdly, we had also, the third one was with respect to the changes we did on some of our structuring with partners, where we moved the commission on trail basis. The outcome of this was, while we had some stress for the year on the revenue, but from a long-term perspective, the business model was very, very clear. And hence, as an outcome of that, we are certain that in quarter 3 or quarter 4, on a quarter's results basis, we will break even, and on a full year basis, we will break even in the coming year. And from a health company perspective, again, I think we had called out that in quarter 3 or quarter 4 of next year, which is FY28, we should break even, and full year basis the year after that. So I think our path through profitability has been very clear, and we've been calling it out in our investor day very categorically. I'll also add a flavor on the asset management company. There also we've been very clear that while we've over-invested to gain scale, we've already reached 30,000 crores. We believe that in the next 3 years, we should hit the 1 lakh crore AUM mark, and that should be the path to profitability. I'll just request the CEOs to add if there is anything. Ashish?
Yes, Ramandeep has primarily outlined all important points. So with the trail revenue, it provides non-linearity to the bottom line. I'll give you an example. Last year, same quarter, our operating revenue was 81 crore with 0 trail revenue. This quarter, quarter 1 FY27, the revenue has grown 32% from 81 to 107 crore, and 15 crore, I'm rounding off, is the trail revenue in this. And it's growing quarter on quarter. So that provides the fillip to the momentum towards break-even. Quarter 4, yes, we are steadfastly moving towards quarter 4 break-even at company level. And on a full year basis, FY28 should be decently positive for us.
I'll request Deepak also to add on the health company.
See, as far as our health platform is concerned, the differentiator really comes with technology and network build. And we continue to invest in technology and network build. The good thing is that our revenue is very diversified. So we are getting revenue from insurance companies, from corporates, from life insurance companies, etc. And therefore, the whole idea is to continue to invest in technology and network, and this should start paying back next year onwards.
So from Finserv perspective, the infusion will continue in health for another 4 quarters?
So if you look at our capital allocation plan for Bajaj Finserv Direct, they don't need capital. From a health company perspective, they'll probably need capital for next 6 quarters is what I believe. But the amount will not be as material. I think 200 to 300 crores is at best we may need. Where we will need capital going forward is the asset management company. We will need a little, not as material as what we've done earlier. And the larger chunk will go into our alts business, which is the newest baby on the block. And obviously what we said earlier, we are planning to set up a reinsurance company, but I think that'll take a while. And that's where I think some amount of capital will be required.
Thank you, gentlemen, for detailed answer. Thank you, and wish you all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, we request you to keep your questions brief. We have our next question from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the opportunity. My first question is on Bajaj Life. We saw a significant jump in group protection business in the current quarter compared to the last year. Just wanted to understand the nature of growth. Is it largely because of revival in the MFI business, or you got into new relationships or new products within some banks which contributed to the growth? So I just wanted to understand this color of almost 100% growth year-on-year basis.
Tarun, you want to take that?
Yeah, Sanket, great question as always. So it's a combination of both, Sanket. I'm sure your Excel sheet is already showing that. Yes, there is a revival of the MFI business across the industry. We've had a significant growth there, and as you know, it's one of our larger books, so that helps. In terms of new partnerships in the last 15 months, we've added more than 20 partners. So if you roll back maybe almost about a year or 18 months back, at that point in time, we started on the journey of de-risking ourselves from banking on the number of partners we had, because at that time we had a pretty large set of 2-3 partners which contributed significant percentage, that time more than 50% of our business. No longer is that so. And the other is in terms of each of these subsectors within the lending sector. Now that is very well spread, and we continue on that path.
Understood, sir. And sir, on life again, I have 2 more. One just wanted to understand again, if I look at your product mix growth, it seems like annuity business grew at the expense of non-par. So is it fair to say that these 2 products compete with each other? So if you target annuity, maybe non-par takes a backseat, or it is other way around, because you typically do regular pay annuities. So whether when you look at the business, we should look it in combo, or you guys internally think both are very different businesses. And second question is on margin again. Means if I do the GST impact, it still comes at 290 plus points on the margin, but still we managed to expand the margins. Is it that we don't want to pass on any pain to the distributors? Whatever the margin accretion will happen will be more led by product mix. That's the call we have taken internally, is the point we wanted to understand.
Okay, great. Another great set of questions. On the product mix, yes, annuity and non-par are similarly structured, but the focused markets are very different, Sanket. One, we should acknowledge the fact industry is picking up annuities because the risk of living longer is getting to be a significant risk, and I would bet a lot of money on that and say that over a longer period, the 50 plus age, which is a significant part of the customer segment in the country, and usually would want to start planning there, is picking this up, which is a good bit. As far as non-par saving is concerned, of course, we haven't yet hit the numbers as we were last year. That is more a product significantly, which also backfired incidentally for the sector. You would know that all persistency got hit for, soon for early gratification products where withdrawals were made possible. So I think that the industry has gotten hit on that. So we've reconfigured and closed that product, and because we do not want to really re-experiment with something like that. And now it should be on an upswing. And yes, these two buckets contribute to the same chassis, but non-par saving will also go, and so would annuities. Should expect that. On margins, while Vipin will just step in. I don't use.
So, Sanket, I wasn't very clear question, but 290 impact on. I couldn't find the question on the pass on. So if you could repeat that.
You said the partners are you. So to an extent, let me say that. See, we have taken a structured approach there, depending upon the kind of channel. And bulk of the sector has also just done that, where we've been able to add for the same commission riders to our products, and commission remains the same, the profitability though goes up. And depending upon wherever we could find avenues of passing, we have passed. There is no need for us to get too specific around that though. But I think what will be different from Bajaj Life versus the rest of the sector is that we were on a path, as you're aware, for the last almost now 21 months on cost reduction as well and savings, and that's cost savings. I think Bajaj Life 2.0 is being able to give us that operating leverage. Does that answer your question, Sanket?
Yeah, that answers broadly in that sense. And maybe I have one on general insurance. Basically, I want to understand the future trajectory of these both tender-based businesses, because we understand that crop renewal probably did not happen as was expected, 3-year renewal. So we have a 1,600 crores of business from that line of business last year, and equally on government health around 3,600 crores. So how do we see these businesses to play out in the current year, given maybe experience on government health and given the crop cycle is not renewing as planned?
Tapan?
Yeah. Now, if you look at the crop business, I think this year, as per the tender that we have got, would be more than the last year. Now, the government health actually was a 2+1 contract. So we should be getting the renewal for this year, because that is how the contract was when we picked up the business. But business on government health will depend on number of lives that are covered, plus the overlap that happened last year in terms of building that. So it may be a bit less than last year in terms of base, but since it is the contract is 2+1, so we'll be getting that. I hope it answers your question.
Understood, sir. And on government health, you intend to repeat, sir, that contract?
Yeah, because it is automatic. It's 2 years +1. That is what tender was when we picked it up last year.
Okay. Yeah. Understood, sir. Yes, thanks for the answers.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and 1. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi, thanks for taking my questions. Just on the reinsurance bit, have you called out the capital that could be required in the business?
So we are, like I said, Nishant, we are at the drawing board stage, and we are putting in a plan together. But I think the way we are going to structure it, we will divide it in a few parts. I think phase one will largely focus on doing domestic, where we may not need too much of capital. And then phase two, once we get the ratings in place, which will be a 3-year process, then we will move into the international market, which is where we will need a big chunk of capital. But we've not quantified it as yet. While internally we have done some scenarios, but we are still to firm up the exact numbers on that.
Yeah, got it. Just on the life business, now, first of all, I think, fairly impressive margin expansion. I was just curious that, in terms of product mix, the mix that I see in the first quarter, is this how we would expect an optimal mix, or is there some more scope for, enriching the product mix?
So Nischint, I think if you look at about last 4 to 5 quarters, our mix has been largely stable, except for retail protection, which has been growing. So if I just go a year back, retail protection for us was about 8.5% same quarter last year. It's 12% this quarter. So I think other than this, our mix has been largely stable. And to the question earlier asked, I think if we look at non-par and annuity, because while they are distinct products, we do play between these two kind of products. So, I mean, par has been in the range of 22 to 25%, non-par plus annuity again in 22 to 25%. Retail protection has grown, and ULIP has been about 45%. I think this is a mix that we believe is sustainable. Should it get better, or should it improve or move towards products with higher margin? I think that's the intent. And if we are able to get our non-par mix a little higher, I think that would be an ambition.
But no, so actually my question was, in terms of non-par protection, what is the thought process, in terms of this ratio? I mean, we are already at 12% now.
I think, look, if I take you 9 quarters, right, except the quarter 1 of FY25, which was June 24 quarter, which was 30% growth. Other than that, we have grown upwards of 40-45% every quarter. Now, obviously, having grown so fast, I think there'll be some moderation in the way the retail protection mix will grow here on. So,
yeah, I just want to add to that, Nischint. So, first of all, thanks for the acknowledgement on the margins. So, Nischint, when we move holistically, and while Vipin's correctly said that you can't expect the same percentage growth because the base is significantly going up, but I must say that the company and the team has done a phenomenal job. I'm acknowledging the team's work in terms of the shift on selling risk. Something that is a different kettle of fish altogether, and for our sector. And now 34% of our customers last quarter were only onboarded with term plans. Another 16% had an enhanced rider on their product mix. So directionally, you should see this number keep going up again and again. And we are not stopping, is all I'll say at this point.
Got it. Just on group synergies, since you raised this point, in terms of number of customers added, what would be, the overlap with other group companies?
Not too much. So, as you know that number of products of NOPs in terms of with group, you mean as in Bajaj Finserv Group, right?
Yeah, that's right.
So not too much actually, because when it comes to NOPs, it's none of the companies in the group really sells too much of retail. So that is barely currently any dependencies there, and largely it is in the open market.
Got it. Any specific reason there was a sharp decline in earnings? I mean, in PAT.
So Nischint, that essentially on account of 2 things that, as Raman mentioned in the opening remarks, because this is Indian GAAP financials, the investment income is on realized basis. Because the equity markets were subdued, so we didn't really have any equity gains that were realized and recorded in the P&L during this quarter. I think that's the largest reason. Obviously, the GST cost gets written off upfront, so that's the other reason. I think these 2 were the reasons. Otherwise, it is BAU.
So last question is just more clarification, more a nature of clarification. What you mentioned is that, in the general insurance business, we are pretty well provided for, including the current, the Supreme Court ruling, because one of your peers obviously made a very large provision, and the other one is, probably reviewing their books. So from our point of view, you're saying that we already done the review and we're fairly well provided.
Yeah, and Tapan answered also, see, given that the homemakers do not constitute a very material, in fact, it's an immaterial number in both the settled and outstanding claims. That is one reason we don't see the impact to be material. And second is clearly that, you see our trajectory of reserve releases. We have always been very conservative. So given both of these, we do not see any need at this stage to strengthen any reserves because of this.
Got it. Thank you very much and all the best.
Thank you.
Thank you. We have our next question from the line of Raghavesh from JM Financials. Please go ahead.
Hi, sir. Thanks for taking my question. I had a couple of questions. First, on the Ind AS financials, can you guide us what is the timeline we have in mind and what is likely to be the impact for both the life subsidiary and the general insurance subsidiary? And secondly, on the life insurance subsidiary, what is the kind of percentage of rider attachment that we are seeing and any aspirational level we are looking at?
So I can take the first one broadly and request Vipin and Avesh to chip in. See, what I articulated earlier, as per the IDA regulations, the effective date of Ind AS adoption was 1st April 26. However, they allowed a forbearance of 1 year, and both the insurance companies had applied for forbearance and have got forbearance from IDA. So for us, the effective date becomes 1st April 27. Now, in terms of implications, I think the biggest one comes from amortization of acquisition costs. As you know, currently in Indian GAAP, the acquisition costs are upfronted, and hence there is a new business strain which one sees. That will go away. It will get amortized over the contract duration. This applies to both the insurance companies. Specific to general insurance, currently the long-term liabilities, which are essentially from the TP portfolio, are accounted for on undiscounted basis. Now, given they are long-term in nature, as per the Ind AS, they are supposed to be discounted. So you could see a big release coming on that front. Third is, which is relevant more from a GI perspective, and it could be arbitrage for us, is there is this concept of onerous contracts under Ind AS, which says that at the time of writing the contract, if one knows that the contract will be loss-making, then you are expected to recognize that loss upfront. Given that we operate closer to 100% combined ratio and the industry is at 120, we believe we could get an arbitrage here because some of the players who are writing loss-making contracts will indeed have to book the losses upfront, and there may be a capital call there. So this is broadly what we are seeing. Now both the companies are doing their numbers, and while we've started filing quarterly numbers with IRD on pro forma basis, but there are a lot of clarifications which we've sought from the regulator in terms of various positions one is to take, and as an industry we've approached them. Some of these clarifications I think will come in due course, and I think we'll start calling out the impact clearly once we have clarity on these. Vipin, Avesh, anything you want to add, please?
No, I think Raman, this was.
Same for me. Thank you.
Thanks. And Vipin, you want to take the rider one?
Yeah, I'll take that, Raman. On the rider, I indicated in Nischint's answer about the impact the rider is already having. Just to give you a little bit more specific data. Now, if I look at term riders which go on term plans and riders which go on saving plans, put together, that number actually comes to 22% of our NOPs, having some rider or the other. There is for both, for term and savings, and the number is 22%. And that's how we measure it. And the intent is to keep increasing that. And I guess that's the way you will keep hearing from us. And that's the guidance we'll possibly only provide in terms of how we look at riders. And we sell multifarious riders.
And in the savings business, the riders would predominantly be in the ULIP business. Is that the right assumption?
It is across. Like I explained, that term itself has, despite term being 33-34%, there are riders on term, and otherwise there's another set on savings. Where ULIP, yes, a few channels do very well on ULIPs and add riders there. And the others, there are also riders available on par and non-par as well.
Okay, got it. Thanks, sir.
Thank you. We have our next question from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity. My question is on motor on damage segment. So the loss ratio in this segment has increased over the last couple of years. So I want to understand which particular segment within motor on damage is driving that loss ratio, and what is our strategy for this financial year in this motor on damage segment with respect to growth and loss ratio management.
Tapan, you want to take that? Tapan or Aves, if you want to take that.
Sure. The increase in the motor own damage claims is what you're seeing is essentially an industry-wide phenomenon. So you see similarly the impact at Bajaj General. Now, there's sorry, was there a question?
So I want to understand which segment basically contributing to this, whether it is private cars, two-wheeler, CV, within private cars, any particular cohort which is leading to this higher loss ratio. And what is our strategy, given that loss ratio is elevated, what is our strategy for FY27 in terms of growth and loss ratio management?
No, our strategy is very clear. We focus on risk selection. We have a return on risk adjusted capital model that we use for our selection basis, and we will continue to do that. As you see that we slow down on motor a little bit. When the time is right, we will increase again. These are all tactical shifts that we do, as we've been doing for the past 25 years.
So we should expect continued slowdown motor on damage, right? Through the year, till the time pricing is not adequate.
No, as Tapan said, there are cycles, right? There are cycles, there are soft cycles, there's hard cycles. It depends on what happens. But we have a daily selection criteria. It's an institutionalized framework we use across our sales channels. We continue to use that to select the risk. Depending on prices, depending on changes in commissions, we will make tactical shifts as we deem appropriate.
If I can add something to this, Raman, Awais?
Yes, please, Srini.
Sure.
I think this is a long-term business. And temporarily slowdowns, I think we're not really bothered. While I know there are a lot of people who look at gross premium as the only measure of top line, we have a large number of customers, usually a large number of policies. Each of these customers, the lifetime value is quite significant. That's how we have built our business in the past. And therefore, if one segment slows, we will have to correct it. Ultimately, the goal is to increase the absolute operating profit if we can. And that will continue to be our goal. And you can grow the absolute profit only with volume margin plays. And sometimes the margins are weak, you have to give a volume, but you have to protect your bottom line. I think that is a very clear strategy of the company over the last 25 years. We will continue to do that.
Sure. And what particular segment in motor OD which is contributing to higher loss ratio? Is it new private cars, or renewal private cars, or any other particular cohort which is showing higher loss ratios increase?
This is Tapan here. It is not so simple. For that, you have to sit together to see a rule engine. No? The micro segment, the segments geography-wise. No? So you can't really bucket it as the segment 1, 2, 3. So that would be too simplistic to look at this business.
Sure. Okay, so that's it from my side. Thank you.
Thank you, Nitish.
Thank you. Ladies and gentlemen, that was the last question of the day, and I now hand the conference over to the management for closing comments.
So thank you all for the great questions, and I think we are done with this. So I think we can close the call. Thank you all.
Thank you so much, sir. On behalf of JM Financial Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.